Are you looking for a friend in financial services? Well, you've come to the right program. Tonight, we're going to be talking about Robo-Advisers, the newest development in Wall Street's continuing attempt to find better ways to manage your money. Is a Robo-Advisor right for you? Well, stay tuned for tonight's Master of Money program starting right now. Tonight's Master of Money program is sponsored by Harvest Investment Services, where they harvest gains and minimize losses, and by Superstock Investor, providing institutional-grade research to individuals. Tonight's special guest is Jeff Garbaz, principal of Superstock Investor. This Master of Money program was produced Tuesday, March 3rd, 2015. Good evening, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and I want to extend my personal appreciation to all of you for spending this 30 minutes with me every week. I sure hope that the program, as we've developed it, offers you a nugget once every week that you can take to build a better and stronger path to prosperity. It's truly my honor to be with you, so I want to thank you from the bottom of my heart for joining us. And let me know at questions@safefinancial.org if there's anything we can do to make it a better program for you. Now, last week, we talked in terms of financial planning, and we covered the 10 key points any comprehensive plan should have. Now, granted, some of these are common sense. We talked about that. You need to plan for income requirements and all that. But we went a little deeper. In talking about income, for example, I shared with you from personal experience that I think you need a little more income than you had while you were working because you have time. And we talked about that balance of time and money. So we talked about that, and then we also had, for the first time on the program, Doug Roberts from Channel Capital Research Institute. Doug shared some thoughts on the volatility in the markets and the bond markets especially. His book, Follow the Fed, is a seminal piece in understanding the Federal Reserve and its impact on interest rates and the markets. So once again, I would urge you to follow Doug at Channel Capital Research on the web. I'm sure he'd love to get you his periodic newsletters. And once a month, we may have him on. We'll try to increase the sound a little bit. I know some people had a hard time hearing it, but we'll try to get that better. But we want to get his insights so that we know from that kind of professional exactly what to look out for in the markets. Now, this week, we're going to change it up a little bit. We're still kind of in financial planning, but we're going to relate to a question I got, and I'm going to kind of jump to the questions component with this. I had a woman who wrote to me last week, and she said, Steve, every week between the halves of the program, you run this Robo-Advisor thing. I'm not sure what that's about, but it's interesting. What is a Robo-Advisor? So I thought tonight we would talk about Robo-Advisers, this brand new development from Wall Street that's taking the street by storm. And yes, there are times a Robo-Advisor can be appropriate for you. There are times they're not appropriate for you. So what we're going to do tonight is we're going to look at Robo-Advisers, what they are, how they're built, how they manage your money, and who some of the providers are to hopefully give you an idea when a Robo-Advisor might be right for you. Now, moving right into the geopolitical side, really big news last week in another failed state. Libya is in the process of collapsing. Now, Yemen had collapsed the week before that and has become just a terrorist hotspot. Libya now is moving in the same direction. The problem that has for you and for me in the purely economic sense is oil. Libya is a major provider of oil, especially into southern Europe. Now, right now, the best reports we get out of southern Europe, Italy, and Libya is that oil supplies have not been disrupted. We hope that continues. Now, even if it were, that should not be a huge impact on global oil prices. We've talked in the past at length about shale oil and how all this fracking oil and gas has really flooded the world with supply. So even if we get a hiccup from Libya, well, I don't think it's going to be that big a problem. But we want to keep an eye on all of these things that we do every week to make sure that we don't get caught in a trap. If we're holding equities and there's a big cataclysm on the market, we want to make sure we know about it. The second issue I want to talk to you about is called net neutrality. Now, interestingly, I actually wrote a piece on this last week. If you'd like to get that video, please just write me at steve@safefinancial.org and I'll get it right to you. But there are a lot of people on both sides of this question. The FCC, the Federal Communications Commission, with a 3-2 vote, approved what is a 335-page operating manual for the internet. The idea is to make it a common carrier, much like AT&T was a common carrier back in the old days of the telephone. Well, the reason people have done this is that there's a fear. It's never happened, but there's a fear that giving the internet service providers like a Comcast the right to charge customers might lead to some censorship in the internet. Now, it's never happened. Here's the reason it's a problem. If you look at the internet, and you're viewing me tonight through Ustream, which is an internet-based service, this video requires a great deal of bandwidth to get to you. It takes a great deal more than text or audio. Well, if you look at a service like Netflix, they consume, and I forget the number, but something like 80% of the available bandwidth is consumed by Netflix after 10 o'clock at night. They're a huge consumer. Well, in response to that, the internet service providers have created a fast lane. They give preferential treatment to Netflix so that that streaming video gets to you faster. Now, they look at that as a commercial enterprise and say, we've helped everybody. We've helped the consumer because they get a faster video. We've helped Netflix because they have a better service. And we, the internet service provider, can charge Netflix a little more for that premium. Well, under the new net neutrality, they won't be able to do that. They'll have to offer equal bandwidth to everyone without discrimination. The problem with that is several things. First of all, the issue of an internet service provider ever discriminating to censor the internet, it's never happened. That's a purely hypothetical. And by assuming now that everyone's on the same bandwidth, those real heavy users like Netflix will be subsidized in their charges by all of us. So what we've done is shifted the cost up from the big guys to the little guy. The other thing this will do is it will stagnate some of the development. Now, the fact is the internet will continue to get faster over time. It will continue to get more bandwidth and broader bandwidth. But this will slow that down, much like the FCC regulations slowed down AT&T. I'll give you a specific example. If you go back to the late 70s, early 80s, before the breakup of AT&T, when it was still a regulated public utility, they fought the cable industry tooth and nail to prevent cable companies from dropping fiber optic cable into homes for cable television. Ma Bell wanted it regulated like the telephone so that the telephone lines would carry cable television. Well, thankfully, we had deregulation and it freed that up, so you now have cable television. Well, this is the same type of thing. We're creating a quasi-public entity out of the internet in which companies won't have the incentive to build faster internet. It will happen naturally. But when you think about the United States today is 30th in terms of internet speed around the world, I think Romania is the fastest, but we're 30th. The last thing we needed to do was throw public utilities on top of this to make the internet providers lose incentive to build a faster, better internet. I think this was a mistake, and we're going to have to wait and see what the full ramifications are. This was another circumstance where they had to pass the bill before we know what's in it. That's a frightening scenario. Over the next weeks, that document will be released, and we'll report back to you if we think it has a material effect on either the economy or on your investments. Now, in the economy, we did get a home sales report last week that home sales slowed in January. Here we go again. Every time you get good news, you get an equal amount of bad. The economy continues to sputter along at this 2.5%, maybe 2.7% growth rate. But last month it was announced new home sales had started to slow down. I've talked about it with you before, but it's another indication that the economy is just not as strong as they'd like you to believe. The other thing of importance in the economic area is that last month consumer confidence fell off of an 11-year high. So consumers are losing steam a little bit. That will lead to a slower market. Now, as you and I have talked, the Federal Reserve sustains a zero interest rate policy. Well, that's forcing money into the stock market, so stocks keep hitting records. The NASDAQ just yesterday hit a 5,000 high again. Now, is that a bubble building? Quite possibly. But we've got a situation with the Federal Reserve keeping interest rates so low, it's causing all of you to say, I've got to go somewhere. I guess I'll go into the markets. So we want to be very conscious of what the Fed is doing. We want to be conscious of all these macroeconomic indicators like consumer sentiment, like housing starts, so that we can begin to see if that trend is going to change. And those trend changes are what make you money in the markets. Last week, speaking of the markets, they were mostly flat to slightly down a little bit, almost negligible. But Monday, you saw yesterday that it boosted up. Again, we're back to a supply-demand issue. There's a lot of money out there. It's looking for a home, so it's going to the markets. We also do have the excitement going on of low oil prices. We have some other things that are kind of ostensibly good. So money's finding a place in these markets, but if you don't have risk controls on your money by stop losses or a sell discipline of some sort, you ought to seriously consider it, because now more than ever you're going to see this thing rise and it could very well turn south, and you don't want to be caught in that trap. Now, as I said, after we come back from the break, we're going to be talking about Robo-Advisers. This is Wall Street's newest development. It's a way to manage your money with low cost, good performance. At least that's how they sell it to you. And we're going to look at what Robo-Advisers are, how they work, what they kind of manage the money, what processes and procedures they use. And then I'm going to give you some of the actual providers so you can look them up for yourself and determine whether a Robo-Adviser is right for you. So stay tuned. We'll be right back on this edition of the Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called Robo-Advisers. But they're not real advisors, because they're not real people. Robo-Advisers crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-Advisers don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. Now, our mission on this show, as you well know, is to teach you everything you need to know to build a better path to prosperity. Our nation, in fact, many people around the world suffer from a lack of financial education, and we're here to fill that gap. So we once again want to thank you for taking the time to join us on the program. And if there's anything we can do, please write us at either questions@safefinancial.org or write me personally at steve@safefinancial.org. We are here to serve you, and so we once again want to thank you. Now, one of the most important lessons we've taught and the most well received is a program I did on the Path to Prosperity audio volumes called How to Select an Advisor. We talked in that 30-minute educational lesson about what kind of characteristics you should seek out in finding an advisor. One of the things we talked about was their discipline, their investment process. In other words, could they demonstrably demonstrate for you, how's that for redundant, but could they demonstrate for you how their process worked? I made it kind of an equation with flying airplanes, where I learned flying airplanes to trust your instruments. Well, managing a stock portfolio is very similar. You learn to trust your process or your instruments. So, pardon me, we talked at length about that. So here's a question. If an advisor following a process is a good thing, why wouldn't you take that to its logical conclusion and use a computer to automate it completely? Well, that is where the Robo-Advisers comes in, because that's what they're caused. Now, I will tell you, I'm a little biased in this conversation. When I started together with two very bright partners, Chicago Investment Analytics, we were pioneers in the work of using computer-driven models to do stock selection. We were very successful at it, largely due to their brains, I think, but we were largely successful, and in 2000, when Schwab bought us, it became the foundation of their Schwab equity rating system. So I'm a big believer in quantifying the investment process. Well, does that mean that robo-advisors are good? Well, I want to explore that tonight, because yes, there are times they're appropriate, but other times they're not. So let's first take a look at what a robo-advisor does in more detail. As I said, what we've effectively done with these things is computerize the investment management process. A simple example of that would be like a target date fund, where it automatically sets your risk parameters based on your age. Well, a robo-advisor looks at your income, your assets, your age, your risk preferences, and automatically sets up a portfolio for you. Sounds good, and academically makes a lot of sense. We've talked about the efficient market hypothesis in the past, and these robo-advisors, I won't say all of them because I'm sure somebody doesn't and I'm going to get caught on the trap. But the fact is, the vast majority of them operate on the efficient market hypothesis. So when you give them your age, your income, your assets, those types of things, and your risk parameters, the automated portfolio manager will allocate your assets based on trying to maximize you along what's called the efficient frontier. That's a point using the efficient market hypothesis where you've maximized your return per unit of risk. Let me be specific. In a couple of sessions ago, we talked about risk. And I talked with you about the way correlation and standard deviation are used to define risk. Well, we know, for example, that bonds have a certain expected rate of return and a certain variability. We know that stocks have an expected rate of return and a variability. By using those things, the efficient market hypothesis will weight your portfolio differently to maximize return versus risk. It sounds good. It academically makes a ton of sense. Now, with that in mind, there are some services I think that are really valuable. I carry on my smartphone, many of you have one of these. I told you long ago about a little service I have called Acorns. It's what's called a roundup service. So it goes into my bank account, and every time I spend any money, it rounds that spend up to the next dollar. It then takes those pennies and puts them in an investment account. I don't have to do anything, it's automatic. But that program, in order to manage the money, uses the efficient market hypothesis to create a series of portfolios from which I can choose. I can choose their more conservative portfolio, the moderate portfolio, or the aggressive portfolio. Now, you know as well as I do, the conservative one is all bonds, the aggressive one's mostly stocks. Okay, that's fine. So, like a target date fund, if you're conservative, it's weighted you toward bonds very heavily. I think these things can be really appropriate. For people who are just starting out, I have a woman who joins me here at the Master of Money show following the TV program, and we talked last week about her circumstance. She doesn't make a great deal of money. She's got a lot of debt relative to her income, and she's looking to get started. Well, something like Acorns, where you can start with literally $5 and build yourself up, it's very appropriate to use one of these robo-advisors in that scenario. The reason is they're very low cost. It makes it possible for the average retail investor to jump in, start building wealth, but do so in a professionally managed environment. That's a good thing. Now, let me give you the drawbacks to these things, and it's why as you get more money, and let's talk about somebody $0 to $1,000, maybe it's a perfectly appropriate vehicle. You get north of about $10,000, and there are a couple of big considerations. Number one, there is no possible way for a robo-advisor to build you a comprehensive financial plan. It's not possible. Much of what your life is about isn't contained in the numbers. Your hopes, your dreams, your passions, your fears, those are not capable of being captured by an algorithm in a computer. So when we talk about a full-blown financial plan, you have to have a human being who sits down with you and understands you in order to build a plan. Because frankly, most of us have parts of our plans that don't make economic sense. They do it because we're passionate about a topic or we want to favor one thing over another. Computers can't understand that type of soft logic. So in an environment where you've got some wealth, and again, I don't know where that number is for you, but I would go as low as even $10,000. It may be, in fact, would be, in my opinion, more beneficial to sit down with a financial planner, even if it costs you a little money, and develop a financial plan that works specifically for you. So that's the number one drawback to the robo-advisors. Let me give you the number two drawback. As I said, I come out of a world of quantitative research. I've studied this stuff in depth. I've spent 25 years of my life in it. But it's interesting because quantitative work, no matter how sophisticated, has a flaw. And that flaw is that it always, in order to come up with an expected return, has to look in the past. Well, as long as the future replicates the past, you're in a good position. You can predict the future by looking at that past. What happens if the future isn't going to look like the past? And let me be specific. Since 1982, we have been in an environment where bond prices have come down from the high teens to zero. We've talked about this at length. That's a fact. So these models that are built look at that world for the last 30 years and say, gee, interest rates come down, bond prices go up, and that's the risk-return relationship they're looking for. Well, what happens in the forward 20 years if interest rates don't continue to go down? I would make the argument they can't. Either they will stay flat where they are, or the more likely outcome is they will run up. When that happens, you pervert the model's understanding of history. It's not bad, it's just easily predictable. The models will be tricked. So what you have when these robo-advisors create an efficient market hypothesis, an efficient frontier portfolio, they're assuming the last 30 years is predictive of the next 30. I'm not sure you and I sitting here today would say that's true. I don't. I think it's a very different world we're in. So the robo-advisor cannot provide you the type of tactical management that we talk about here on the Master of Money. When all of the road signs say get out, it's probably a good thing not to be in the market. Well, the fact of the matter is the robo-advisors don't have the ability to do that. They're in the market. It's just a matter whether they're in this percent stocks or this percent bonds. So as you look at these things, there's a time they're appropriate. Because if you want to manage an equity portfolio, okay, hire an automated manager to run the equity portion. But have something in there that can kick you out of equities when really all the signs tell you, run away, this market has hit a peak. Somebody wrote me recently and they said, you know, the NASDAQ's approaching 5,000, it just crossed it yesterday. Is that another bubble we're building? I don't know. It could go up to 6,000. I don't know the future. I don't have a crystal ball on that. But what I can tell you is there's a possibility it will drop, and therefore I want to put risk controls into it. If I'm in the NASDAQ, I have a sell discipline at some point in there that will preclude me from getting slammed if the market drops precipitously. The robo-advisors can't do that. So there are your two drawbacks. They don't give any personal attention to your real deep needs. And number two, because they don't understand tactical management, that's not been back-tested thoroughly enough, they can't do it. But unfortunately for them, the last 30 years probably will not be replicated in the next 30. So those are a couple of key things on robo-advisors. Now there are some, we're going to give you 7 of them that I found that, you know, if you want to touch in that space, and especially if you have a child or a grandchild and you're looking, saying, I want to get them into the markets, how can I do it with just $100 a month or something like that? There are some of these that will let you in at very small minimums because they're automated. They don't have cost. And here are 7 of them: Betterment Financial, Wealthfront, Future Advisor, Bloom, and yes, there's an extra O in that. That's not a typo. Motif Investing, and here's one of my favorites, Caffeine Fix. Now, it's interesting. A lot of the computer guys who build these programs, they're not finance people, by the way. They're usually computer people who build these programs, but they like to put creative names on it. We are getting into the millennium generation, and they, I think, are hyped up on caffeine as much as I used to be. And then finally, personal capital. But obviously, if you want to get more detail on any of these, write me at questions@safefinancial.org, and I'll try to get you the best answer we can. But these robo-advisors, as you think about your plan, if you have one part of your portfolio that you think needs to be better managed, it's a possibility. Write us and we'll talk about it. But if you have a young person just getting started, that's where these are truly appropriate. It helps them get into the world of investing, helps them, assuming that the markets don't totally die, they're going to make a return on that money. It may not be double digits, which you and I would hope for, but they will make something, and that hopefully will get them into a mindset of becoming an investor, which is what we want, savers and investors. To digress a little bit, I gave a speech a couple of years ago at the Chicago Federal Reserve talking about the lack of savings in America. Our savings rates in this country are horrendous. That does not bode well for the future. Now, it's easy to understand why people don't save money. When you can borrow money at zero, well, that means spend. And when your savings generates zero in the bank, that says don't save. I get it. But we need to start creating a nation of savers. And one way to do it, maybe to use one of these robo-advisors for someone you know who's just starting out. Now, we move on for tonight to the super stock section. Jeff and I had a long talk yesterday, and I was pleased that he wanted to report on some of the stocks he's talked with you about. He's taken some nice gains in those stocks, so we're going to talk about those tonight as we go to super stocks. So here we are. Jeff, let's hear from you.
Hey, Steve. Thanks for having me back again. This week I thought I'd talk a little bit about the Morning Matters portfolio. We started the portfolio back in April of 2008. And the concept was to create a 12-stock portfolio that our readers and investors could follow and actually trade on. The reason I picked 12 stocks is each stock has about an 8% weighting. 12 times 8 gets us to 96, leaves a little bit of cash. And with that, I don't think we're taking too much risk. If we have a really bad day for a particular stock, and let's say it loses 25% of its value, which can happen, that'll hit the overall value of the portfolio by about 2%. So we've been pretty fully invested here until the last couple weeks, and we've started taking some profits. One thing that I've been trying to do, and I think is key for any investor in the current tax environment we're in, is to try and create long-term capital gains as opposed to short-term capital gains when as much as possible. So we had been in Visa, had a really nice gain on it, and we knew at the beginning of the year we'd be able to come out of it, so we did that. Costco was a similar story, but also slightly different. One of the key things we do in looking at our valuation is looking at our stock scorecard. And in the case of Costco, a year later, it had not only gotten above its price target, but it had also gotten above its upper target. So as price started to kind of stall out after a really nice advance, we decided to take profits on it. Key thing, though, is always look at your dividends. In the case of Costco, there was a $5 special dividend. We needed to hold it to record date. We held it beyond 1 day for record date and then took the profit. So always make sure to look at when you're selling a stock, are you close to a record date to see if you can sell it. So with the current selling that we've done, our 12-stock portfolio is now down to 7 stocks. We would have been 6, but we recently added Ralph Lauren, Polo Ralph Lauren, symbol RL. And this is how we really like to buy stocks. The stock had gotten really hammered since the end of the year. It was above $185, and we were able to pick it up. I think it was around 137 and change. So it dropped from the end of December from 185 down to 137. Now clearly there was some news related to that. With the dollar being so strong, they've been hit a little bit on a currency standpoint. But from our take on the dollar is kind of approaching a top. I really don't think that the dollar has a lot more to go. And actually, if you look at several foreign currencies, they're now starting to stabilize and move a bit higher. So if we get any pullback in the dollar, that's a big benefit to Ralph Lauren. And the other key theme on Ralph Lauren is it's actually trading at a 55% discount to its price target. Whenever something gets below 50%, I call that stupid cheap. And if it's stupid cheap, I have never actually added a stock into the super stock portfolio at a 50% discount and not made really good money. My definition of that is at least 25%. So I'm really hopeful that Ralph Lauren, we can make upwards of 25 towards 50% over the next year. What's interesting about Ralph Lauren also is that we had it last year and we only made 12%. I sold it and I came back to it again. A key thing to do is think about names that you've owned that you know well, and when something bad happens where it creates an unusual opportunity, then we got to jump on it again. So that's some, I think, really good ideas on how to help managing a portfolio in our 12 stock portfolio. Key to our 12 stock portfolio too is our turnover's been pretty low, about 130% a year. So we're coming in with about 15 new names each year. And you know, we're watching names that we've held now for a considerable period of time. One name we've held, Red Hat, we've got over a year held on it. We owned it in September of 2013, so now about a year and a half into it, and we're watching that one as well. So key, always take a look at your stocks in your portfolio and think about how much cash you want to have. Those are my tips for this week. Thanks, Steve.
Thank you, Jeff, as always, for being such a positive contributor to the show. We really do appreciate it. We ask you to check out Superstock Investor on the web. They really do provide professional-grade research to individual investors. It's quite an interesting business model Jeff has, so I do appreciate him coming in tonight. My friends, I want to thank you for spending another night with me. I hope that tonight's discussion about Robo-Advisers helps. I hope our discussion about Libya gives you some enlightenment on a program you didn't, or an issue you didn't know was happening, and certainly our talk about net neutrality. We will keep you posted as that comes through the pipeline and how it affects the net and the economy as it grows. But we appreciate your always being here. As you know, the Master of Money is brought to you by the Society to Advance Financial Education. We're a not-for-profit organization dedicated to empowering individuals with the knowledge they need to thrive and prosper in a very complicated 21st century. We want to provide real help for real people, and the Master of Money program is one way to do that. As always, we do want to thank our sponsors, Harvest Investment Services, as well as Superstock, and our wonderful musicians, Ron Blake and Chris Yance, who help us put on the program. Have a happy, prosperous, and wonderful week ahead, and I look forward to seeing you next Tuesday evening for another edition of the Master of Money.